Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar and here's a look at the stories for the day. Surprise has almost become an inherent part of our bill payments. Usually, there is a marked difference between the charges that we are promised at the beginning and what we shell out at the end of the service. Whether we are dining at a restaurant, booking an air ticket, or purchasing a movie ticket online. So in our report, we ask if regulatory intervention is required to ensure price transparency.
If you don't want to pay a service charge, don't enter the restaurant. This is what the Delhi High Court remarked as it stayed the recent guidelines issued by the Central Consumer Protection Authority, which said that restaurants cannot levy service charges by default on food bills. The stay order was passed on a petition by the National Restaurant Association of India, which represents more than 5 lakh restaurants. However, food outlets have been told to display such charges clearly on their menus so that customers know. Restaurants generally levy a service charge of 10% on the food bill. For many customers, seeing the service charge component at the time of bill payment comes as a surprise. The NRAI has urged its members to comply with the conditions spelled out by the High Court. Moreover, some restaurants do not print GST inclusive prices on their menu. A customer expecting to pay a 500 rupee bill ends up paying almost 580 with GST and service charge that is revealed to him after the food is consumed. Complaints about the lack of transparency in pricing are not limited to just the restaurant and hotel sector. In May, the CCPA issued notices to cab aggregators Ola and Uber for alleged violation of consumer rights and unfair trade practices. One of the primary issues raised in the notices is the lack of information on the algorithm or method used by the companies to charge different fares for the same route from two individuals. Other issues included unreasonable levy of cancellation charges, wherein users are not shown the amount of time within which cancelling a ride is permitted, and the amount of cancellation charge not being displayed prominently on the platform before booking the ride. The issue of inclusion of charges for add-on services, such as insurance, by pre-ticked boxes without obtaining consent by explicit and affirmative action was also raised. On the same lines, a cursory check on top online aggregators showed that the platforms do not provide a breakup of taxes and other charges while booking flight tickets. These charges include aviation security fee, passenger service fee, user development fee, regional connectivity scheme fee, and common user terminal equipment charge. The applicability of the platform's convenience fee, typically non-refundable, is disclosed only in the last step of the booking process. Similarly, the amount of convenience fee on online platforms for movie or event bookings is known only towards the end, before the consumer makes the payment, giving an impression that outgo is being vastly inflated.
The Consumer Protection Framework, including the main Act and also the e-commerce rules framed under the Act, already have broad contours of requirements for transparency in pricing. That is sort of indicated through what it means, to be implementing any unfair trade practices, which include any misleading information, whether relating to price or any misleading information which leads a consumer to believe something different than what is being offered. Expanding on that, the e-commerce rules specifically provide a requirement for any e-commerce entity operating an inventory-based model, whether for services or goods, to display specific breakup of prices, including any taxes, charges, any other fees, whether they are voluntary components or compulsory components. And this requirement also extends to sellers selling on e-commerce marketplace platforms. And this information is required to be provided by every seller on that platform. And that in turn is required to be displayed by the e-commerce marketplace to all its users. While this framework exists, the different use cases in which this violation may take place are not set out or contemplated, and that will depend on a case by case basis, and that will likely be a determination by the CCPA, which is empowered to take decisions in these matters and on these issues.
Consumers have also complained that prices shown on food delivery platforms are in some cases 20 to 30% higher than the offline prices at the restaurant. High commissions charged by such platforms have forced restaurants to display higher prices online. Transparency here would mean Zomato and Swiggy should have a system that notifies the customer that the prices on their platforms are much higher than the physical menu price for the same products. According to IndusLaw's Shreya Suri, there is also a separate requirement for e-commerce marketplace entities to not manipulate the prices of sellers on their platforms. If any marketplace e-commerce entity is charging a markup on its own, that is also restricted under the e-commerce rules, which are part of the overall Consumer Protection Act framework. Also, while the framework already exists, the Central Consumer Protection Authority is struggling a bit with implementation, and there is significant industry pushback. What constitutes pricing manipulation and the degree and extent of pricing breakup that needs to be displayed is still a matter of discussion and debate at present.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like the restaurant industry, the FMCG sector too went through a difficult phase in the last 2 years. High input costs and a drop in demand, especially in rural areas, forced the consumer goods sector to bite the bullet. It passed on the price hike to consumers and reduced the grammage per pack. But after a drop in the prices of palm oil and some other commodities, are things looking up for the sector now? Watch our next report to know.
Fast-moving consumer good companies effected a price rise of 10 to 15% over the past few months. They also slashed the weight of biscuits, juices, and several other packed items to make for the loss being incurred due to the rising input cost. Almost all the spices have seen their prices increase in double digits over the last 1 year. Chili powder rose by 12.6%, while garam masala surged 15.6%, according to data from Bizom, a retail intelligence platform. Prices of turmeric, jeera, and coriander increased 11.6%, 12.7%, and 16.9% respectively during the last 1 year. In the essential food category, prices of milk have gone up by 5.4% over the last year period, while that of atta and bread have risen 8% and 12.3% respectively. Branded bathing soaps and detergents, which come under the essential non-food segment too, have seen double-digit increase in prices in the past 1 year. Rising prices have also affected drop in consumption, especially in the rural areas. FMCG companies reported decline in volumes across categories in the last couple of quarters. According to a Nielsen report, volumes shrank 4% in the March quarter, led by a sharp drop in the non-food category. In the June quarter too, volumes remained under pressure. FMCG giant HUL's first quarter sales growth was largely driven by price hikes, while the underlying volume growth was muted at around 6%. Godrej Consumer Products Limited and Marico too said they expect a volume decline in mid-single digits in the first quarter. Experts say FMCG volumes might have contracted around 5 to 8% in the June quarter.
We expect some recovery happening in this quarter itself, towards the end of this quarter. The end of this quarter would also mean, beginning of the festive season. Typically, from mid-August onwards, we'll see the onset of festive season. We expect volumes to go up then. There are 2-3 reasons behind it. First reason is after 2 years of lockdown, this would be the first year when people would be freely going out. We are very hopeful that this would be a festive season where people would really venture out after 2 years, and the buying would be really good. So that's one big hope as far as FMCG companies are concerned in terms of revival of demand. Secondly, the concern last year, I'm talking about last financial year, was also being partly driven by the slowdown in growth or tapered growth of rural India. Thankfully, because of 2 reasons, we have seen strong revival in demand in rural India. Demand revived in rural India. We have seen a very strong revival in rural India, demand in rural India in last 1 quarter. And hopefully, given the situation and with the onset of festive season, that would improve. So second half of the year is when we see a very good recovery or complete revival.
Palm oil, one of the key commodities used in FMCG products, has come down to about $1,200 per metric ton from the peak levels of $1,800 to $1,900 per MT. So, is the worst behind for the industry, and could there be any relief for consumers going forward? Akshay D'Souza, Chief of Growth and Insights at Bison, said a slight decline in commodity prices in some categories is likely. However, there is no pressure on companies to ease the price burden. FMCG companies might look to focus on effective rates by offering higher value to the consumers at the same price to boost volume growth. There could be a competitive pressure on the companies in terms of offers and schemes ahead of the festival season. Beating analyst estimate, HUL on Tuesday said its standalone net profit for the quarter ended June 2022 was up 11%. HUL MD and CEO Sanjeev Mehta said, while there are near-term concerns around inflation, the recent softening of commodities, monetary and fiscal measures taken by the government augur well for the industry. India's rural areas contribute 35% to overall FMCG sector sales. If the monsoon is good and steady over the next month, it could result in higher rural incomes and up rural consumption.
See, one of the things that will play out for FMCG companies, not the direct produce companies, for example, edible oil, wheat, whether the products are direct, right, branded, that will have to pass on. That will pass on because that's the major cost structure. Where you are a component of the cost structure, chances are that they will hold on to the prices. And I think, and I'm saying this across entry-level packs, mid-level, or even high-level packs, they will hold on to prices. But what they will do is they will start creating more consumer offers or secondary scheme offers for retailers to pick up more. So you will see them starting to play a lot more on consumption-driven schemes and offers, which will kind of spur that usage of the product. So I think that is something that will happen pretty quickly. And as we enter festival, I will see that in fact becoming a key strategy playing out going forward.
Amid inflationary pressures, the recent decision to impose GST on pre-packaged food items of up to 25 kg like atta, paneer and curd could add some pressure on volumes in the short term and also make items costlier for the consumers. A recent report by ICICI Direct Research said that prices of commodities may fall in 3 to 6 months due to the rise in interest rates globally. FMCG companies are betting heavily on the festival season to boost overall volume growth, and a demand revival on the back of good monsoon could augur well for the industry.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Things seem to be looking up for stock markets too. Nifty closed above 16,600 on Thursday, while Sensex gained 284 points. Meanwhile, shares of Reliance Industries seem to be at crossroads. On one hand, the government has slashed windfall tax on fuel exports. On the other, Singapore gross refining margins are down from a peak of $30 a barrel to just about $4 a barrel. This, analysts fear, may evaporate the conglomerate's abnormal profits in Q1 FY23. Our next report takes a dive into the road ahead for RIL.
The government's latest diktat to cut windfall tax on petrol, diesel and jet fuel is likely to benefit India's biggest conglomerate, Reliance Industries, at two levels. Firstly, RIL is one of the two private players accounting for a major chunk of the country's overall fuel exports. Secondly, the Mukesh Ambani-led company runs India's only export-focused refining unit in Gujarat's Jamnagar. Thus, the decision to remove levies on exports from refineries located in Special Economic Zone will give a leg up to RIL.
RIL's oil refining business is extremely sensitive to such taxes, wherein the initial imposition of it was expected to hurt its earnings by anywhere between 30 to 40%. The bottom line was expected to be impacted by that quantum, but now with reduction and relief of sorts across certain crude related products, one can expect margins to sustain a little bit longer for Reliance Industries. It also lends a lot of strength to the oil refining business in terms of cash flows.
While fundamentally the developments will support the stock, it is seeing resistance at 200-day moving average as per technical charts. Reliance Industries shares are hovering around 200 DMA of 2,507 rupees. Only a decisive move above this level would push the stock towards a level of 2,700 rupees. Meanwhile, the company will release its June quarter report card later today. According to analysts, RIL will likely report a strong set of numbers for Q1 FY23, driven by robust oil earnings.
With Reliance multiple feedstocks, obviously the refining business is going to show supernormal profits, at least for this quarter. And this is not subject to windfall tax at all, because the windfall tax came only after 1st July. However, I think with the fall that you've probably seen in Singapore GRMs, which have come to very low single digits, $3.5 or $4 per barrel, the expectation largely is that, is it sustainable? On the retail part of the business, when it comes to Jio and Reliance Retail, I think the traction that we've probably seen is expected to continue. The unlocked trades for retail will continue significantly. And because of that, I think the kind of expectation that one has both in terms of volume and value growth should continue. As on now, I think the balance sheet is strongest Jio standalone as a business within the integrated part of the overall consolidated numbers. And therefore, any ARPU increases, if they're coming through in the next few months, is going to be a welcome positive in terms of stability of cash flows that the standalone Jio business can offer, as well as all the other expenses that probably need to get meted out in terms of either the 5G spectrum and the other OPEX requirements.
Overall, Bloomberg's consensus estimate pegs consolidated net profit at 21,615 crore rupees on net sales of 2.25 trillion rupees. EBITDA is seen around 38,500 crore rupees. Meanwhile, Bandhan Bank, Coforge, HDFC AMC and JSW Steel are other major companies due to report their Q1 results today.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Markets tend to witness pullback rallies or reversal after witnessing steep one-sided moves. Our next report will help you understand the 3 key parameters to identify a pullback and how can you use it for both short-term and long-term gain.
A pullback is a short-term reversal phenomenon where a stock or an index corrects or rallies after witnessing a one-sided move in the opposite direction. For instance, if a stock or index is seeing a healthy correction after a long-term upward trend, then the pullback can be looked upon as an opportunity to enter a trade with an aim for higher returns over the long term. So, whenever a chart portrays a rally on breakout, it does also provide intermittent corrective moves. So, if you are someone who is new to the concept of pullbacks, use the following key parameters to ascertain the trend reversals. Volume is the first parameter to study a pullback. Trading volume drops significantly in case there is a slowdown in the momentum. However, in case volume is picking up, it could indicate a change in trade. Second is news-driven triggers. Negative news can trigger a sudden sharp fall in the underlying, but the price tends to reverse once clarity emerges on the news development. The third parameter is support and resistance levels. Pullbacks can continue till a level where there is strong buying interest and buyers are picking stock due to attractive pricing. Now that we have understood the key triggers of a pullback, let's understand how to identify and trade a pullback rally. A pullback will show a peculiar chart structure with volumes staying sideways. As can be seen in M&M's chart, lower volumes show consolidation with the stock taking support around Fibonacci retracement. In such a scenario, one can blindly look at accumulating the stock. However, one needs to be cautious as a biased interpretation of a pullback may result in losses and fear of capitulation. The corrective may turn into a negative if crucial supports are breached with aggressive volume. It's better to exit the stock during such times. So, how can you ride the market pullbacks and be sure when to exit or enter a stock? Well, technical indicators can help you do this. Occasionally, technical indicators assist in identifying a pullback. The most significant is the price action on tech chart. If one sees the relative strength index or RSI falling from overbought condition but no significant fall in stock price, it may be interpreted as a negative divergence. It is better to wait at this point in time rather than buying the stock. Similarly, the moving average convergence divergence or MACD makes a negative crossover with price which exhibits a sideways trend. In both these situations, significance should be given to the price momentum and moving averages. On pullbacks, these averages will not show weakness or turn downward. Instead, they will gradually continue their current trend and hold the price momentum. Now, with these points in mind, let us understand the implications of pullbacks. A pullback clearly suggests that the continuation trend is intact and the price should witness buying momentum at higher levels. Further, pullback lows are crucial buying levels that set the base for the next upside. Till the stock holds these levels, the bigger trend remains highly optimistic. A trader should keep in mind while trading with a pullback strategy is one's risk appetite. Failure to exit a wrong trade may create disparity and damage the overall performance.
I will achieve, I will fly high, SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Pullbacks are usually short-term dips of about 5 to 10%. That's all for today. We'll be back with more news and analysis in our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.